Hello. Recently, quite a bit of national attention has been directed towards corporate America and how gains from the private sector are shared across various constituencies. I would like to talk a few minutes in defense of free markets. In an earlier talk, we discussed how corporate finance is made up primarily of three core concepts. The first, businesses should obtain the lowest cost financing possible. Second, managers should only invest in good projects where a good project is defined by its rate of return being greater than the cost of financing. That is, only invest in projects whose returns are greater than the financing cost. The third concept requires managers to return excess cash to shareholders when there are not enough good projects. These three concepts, known as financing, investment, and payout criteria, are not complicated, but need a guiding principle to ensure their execution. That principle is the shareholder wealth maximization rule. Before making any corporate financial decision, financial managers, well really all managers, should ask themselves, will this maximize shareholder value? Will it make our owners better off? If the answer is yes, proceed. If no, find another way. The shareholder wealth maximization rule is controversial and sometimes political. Recently, in the last week or so, Senator Elizabeth Warren, Massachusetts senator, penned a Wall Street Journal opinion article entitled, "Companies Shouldn't Be Accountable Only to Shareholders." And for the rest of the talk, when you see the slide words in italic, those are Senator Warren's words from her opinion piece. In it, she says, "My new bill will require corporations to answer to employees and other stakeholders." Senator Warren argues that before shareholder value maximization ideology took hold, wages and productivity grew at roughly the same rate. But since the early 1980s, real wages have stagnated even as productivity has continued to rise. Workers aren't getting what they've earned. That's her point. In the article, she criticized the theories of an economist that won the Nobel Prize in economics, Milton Friedman. Milton Friedman is a Nobel Prize winning economist who wasn't afraid to say and propose things that are controversial. And one of his more famous quotes is, "The combination of economic and political power in the same hands is a sure recipe for tyranny." So you can see how people with certain politics, people that would like to have more control over business via politics, would not be big fans of Milton Friedman. In fact, Milton Friedman was pretty dismissive of putting the federal government in charge of the economy at all. In fact, another one of his quotations, "If you put the federal government in charge of the Sahara Desert, in 5 years there'd be a shortage of sand." Well, that's funny, but we can see how when government takeovers of economies can have disastrous results. We have to look no further than just look a little bit to the south of Venezuela. What's happened when the federal government took over the economy there? We had the largest OPEC oil-producing nation, extraordinarily rich, with the highest income levels in Latin America as recently as the mid-1990s, now collapsing. And finally, here's one of my favorite his sayings, "There ain't no such thing as a free lunch." But enough of that. Let's look at the evidence and see if there's justification for doing away with the shareholder wealth maximization. Senator Warren is correct. Over the last 70 years, we've seen here in the United States the per capita GDP, this is the gross domestic product per person, on average increased till today it's almost $60,000. So Senator Warren is correct, though, that the gains are not being shared equally. So even though we've seen this, by the way, this is tremendous wealth creation sustained over a long, long period of time. This is almost unheard of in the history of mankind. Senator Warren is correct that the portion that goes to workers hasn't kept up. So shareholders, the owners of corporations, are getting more of a stake of this GDP growth than the average worker. So recall, Bo, from your Econ 101 that productivity gains come from increased capital investment, where increased technology improves worker productivity and increased worker skills via more training and higher education also increase productivity. Of course, the two effects, capital investment and increased skills, are intertwined. And we can see here in the United States that Senator Warren is absolutely correct. Right around 1980, when Milton Friedman's ideas were becoming well known, we see a separation where real hourly compensation is pretty much flat. When we say real, we mean inflation adjusted. Real wage gains are pretty flat, even though we see productivity increasing. So Senator Warren is absolutely correct that we've seen a decoupling, because prior to that time, as productivity increased, compensation increased. So is this really due, though, to the shareholder wealth maximization? Well, it could be. We can't really say that it's not. But think about all the other things that happened right around 1980. So one of the things that happened, for example, in 1971, that we had the end of the Bretton Woods Agreement. So we got off the gold standard and started going to fiat, or printed money. So instead of having the dollar bill backed up by an amount of gold, we have it backed by the full faith of the U.S. government. And also, post-1970, we went from a high tariff, so we charged high tariff on our imports, to a low tariff regime. So we've had more global competition. Economies have become more globally integrated. So a lot of those low-skilled jobs, they went to low-skilled markets. So, for example, we no longer see much in the way of apparel production here in the United States. That's traditionally an area, an industry that pays very low wages. We now see this in low-wage countries, and we don't see it so much here. We've also, since the 1980s, we've seen a decline in our manufacturing jobs. Absolutely true. We've also seen a tremendous increase in technology around 1980. So around 1980, we began to see things like computers that no longer took up entire buildings. We saw desktop computers, personal computers. We saw enormous wage gains associated with people that suddenly were much more productive because they were able to use all sorts of different technologies, not just computers on the desktop, but we began seeing a lot more technology in other areas as well. What did all that technology take? That technology took a lot of capital investment. So if companies were going to take advantage of all these new technologies that were coming online available around 1980, they had to spend money. They had to make capital investments. And workers that could exploit this new technology, higher skilled workers, they were in more demand. But the low-skilled worker, not so much, unfortunately, for them. Interestingly, this is not really related to this particular topic, some other things happened around 1980 that changed. Right around 1980, we saw companies like Apple, Microsoft get their starts. We saw IBM right around this time develop the first personal computer. Also around 1980, back in the 1980s, funding for public higher education was reduced substantially. So for example, here in the state of Texas, back in the early 1980s, the state provided about 85 to 90% of the operating cost of universities, and tuition provided the remaining 10-15%. Today, the state of Texas only funds about 15% of the operating cost of universities, and tuition funds about 85%. So if you're wondering why has tuition became so much more expensive over the last 20, 30, 40 years, well, a big reason is simply less public funding. And interesting, state of Texas and most other states started spending less on education right at the time when education became more and more important because of all the new technology. So not surprisingly, if we look at wage growth across high-skilled and low-skilled workers, now, just as a proxy for that, we call high-skilled workers workers that have bachelor's degrees. We can see over From 1980 to 2014 here, we've seen, and this is in real dollars, we've seen substantial increases in average pay for high-skilled workers. A proxy for low-skilled workers, workers with only a high school education. Our high-skilled workers here, represented by the red, have actually seen slight wage declines, and low-skilled workers, people that don't even have a college education, we've seen their declines even more substantial. So while there's been gains in per capita GDP and there's been gains in productivity, those gains are not being shared by all workers. High-skilled workers are doing quite well, low-skilled workers not so well. Senator Warren also writes, companies are also setting themselves up to fail. Retained earnings were once the foundation for long-term investments. But from 1990 to 2015, non-financial, I think non-banks, U.S. companies invested trillions less than projected, funneling earnings to shareholders instead. This underinvestment handcuffs U.S. enterprise and bestows an advantage on foreign competitors. Well, setting aside for a second the idea that an academic and politician such as Senator Warren is an expert on business, let's look at the evidence and see, is there an underinvestment problem? And has this led to a competitive disadvantage with our foreign competitors? So again, looking at the data, Senator Warren is correct. As we look up here right about to 1980, we kind of see this flat. This is the combined amounts of dividend and stock buybacks by U.S. non-financial firms, so as a percentage of GDP. So for most of the time, it's less than 2% prior to 1980, and we see that it increases as a percentage of GDP post-1980. Again, this is true, but can we say that that's caused by shareholder wealth maximization rule and free markets, or is it caused by something else, or is this actually something that should be good? Because if we look at this, what's the saying? People that invested in the markets have done really well post-1980. You can see that their paybacks just from dividends, not even counting the increased price in the stocks, has increased substantially. And looking here at stock buybacks, remember this previous slide here, this is combined stock buybacks and dividends, companies buying back their own stocks. So that's one way of getting money back to investors, because as a company buys back stocks, there's fewer shares outstanding when they buy back their own shares. So the remaining shareholders own a bigger proportion of the overall company. And then dividends paid after taxes are another ways that companies can give money back to shareholders. So looking at stock buybacks, we can see that it's quite variable. The dollar amount of stock buybacks over time, this is for the S&P 500, and there's 500 companies in the S&P 500, and we can see that here, recently the last few years, there's between 360, 370, 380 firms per year are issuing some type of, repurchase plans. So companies are 380 companies out of the S&P 500 are buying back their stock. Well, is that necessarily a bad thing? Well, a lot of companies issue stock options. Not only do their CEOs, I agree that CEOs are paid probably more than they're worth, but setting that aside for a second, a lot of employees have stock options. So companies, as employees exercise those options, companies have to issue and buy back their shares to avoid diluting the shares of the existing shareholders. So just because there's a lot of stock repurchasing doesn't mean that it's just going to a select few upper level executive employees. And if we look at dividends, and here we see Senator Warren is absolutely correct. If you look prior to 1980, dividends were kind of small. These are in real dollars. And we can see post-1980, dividends have exploded. So we're going from around 1980, maybe around $100 billion per year in dividends, up to about $1.2 trillion in dividends here towards the end of the sample period. So Senator Warren, again, is absolutely correct. Companies are buying back their stock more, and they're paying out more in dividends. But look how, since 1980, how much corporate profits have increased. And this is what Senator Warren is not really addressing, that companies are becoming much more profitable, generating much more dollars in profit than they were prior to 1980. So if she wants to blame that on the shareholder wealth maximization rule, man, that's great. Companies are making a whole lot more money. Their shareholders are getting a whole lot more cash from these companies as a result of those profits. That's going into stock buybacks and dividends. That's a pretty good thing. But is it somehow increasing? Again, the senator is right. If we do the math here, about 90% of companies in total profits are paid out in dividends. Keep in mind, not all companies are profitable. Think about an Amazon. It has a huge market capitalization, but it doesn't really pay out anything in dividends. And then you've got companies more like cash cows. Think of a Heinz company here that pays off almost 100% of their profits in dividends. But if we look at dividend yield, in other words, dividends as a percentage of the current stock price, we can see that over time, if anything, it's falling. So companies are not paying out more and more dividends relative to the value of the company. In fact, they're paying out less dividends with respect to the value of the company. All right, remember Senator Warren also said that companies are putting themselves at a competitive disadvantage because by paying out so much in dividends that they're not going to have enough for capital investment, and that's going to put them at a disadvantage to their foreign competitors. Well, let's just take a look at that. So in the United States, and here just to kind of proxy the U.S. market, we have the Standard & Poor's 500 here in the blue line, and we have Europe and foreign developed stocks here. So here is Europe right down here. And from about 1980 to now, we see that if you had invested $1 in the stock market way back here in 1970 something, today in the U.S. you'd have almost $1,000 if you had invested in the U.S. And most of that growth occurs post-1980 when this whole idea of shareholder wealth maximization rule took place. But what about Europe? So in Europe, they don't have the shareholder wealth maximization rule as their principal guiding force for most companies. They have more of what Senator Warren is proposing, more of a stakeholder enrichment, where all stakeholders are treated equally. So this would be the unions, this would be communities, the government, the workers, as well as the shareholders and different other types of investors. All their concerns would have to be jointly considered and jointly treated as equal. How's their financial performance been? So in Europe, if you were to start off with $1 back in 1970 something, you would have about, well, let's be generous and call that $60, $70. So would you rather have $60 or $70, or would you rather have somewhere around $600, $700, $800 invested in the U.S.? So Senator Warren is wrong on the facts on this one. Shareholder wealth maximization rule and giving more money back to shareholders when they don't have enough good investments has actually resulted in higher valuations. So no evidence that shareholder wealth maximization rule is a problem as far as companies' competitiveness in the long run. So, okay, maybe at this point you say, okay, maybe, all right, so shareholder wealth maximization and free markets, maybe Senator Warren would say, okay, they generate more total wealth, but it's still not a fair system. So again, from Senator Warren's article, between 2007 and 2016, large American companies dedicated 93% of their earnings to shareholders. And we saw that she's absolutely right on that. And then she further notes that because the wealthiest 10% of U.S. households own 84% of American-held shares, the obsession with maximizing shareholder returns effectively means America's biggest companies have dedicated themselves to making the rich even richer. First, a little bit of common sense. As people get older, on average, they own more stocks. So on average, somebody who is 65 years old is going to own a whole lot more shares, a whole lot more stocks than somebody who is 25 years old. So the people that own most of the shares are people that are older because they've had a lifetime of earning to buy more shares. The shareholder wealth maximization also fosters innovation. So look at the largest companies in 1917. So we had U.S. Steel, and these are, by the way, in inflation-adjusted dollars. So it had a market cap of, Its market value was $46 billion. Then we had American Telephone, AT&T, you know that is today, is $14 billion. Standard Oil, $10 billion. Bethlehem Steel, $7 billion. Swift and Company, this was a meat processing company. International Harvester, they made farming equipment, $4.99 billion. DuPont. Those were the big companies in 1917. In 1967, the big company was IBM. AT&T had grown, so IBM and AT&T, relatively high-tech companies, along with Eastman Kodak, they gained a lot from 1917 to 1967. Then we have General Motors, Standard Oil, Texaco, Sears, 1967. Now Sears is going bankrupt. We also had GE. And you can see here, the most valuable company in 1967 was $256 billion. American AT&T's $200 billion. General Motors $171 billion. Now, look at the biggest companies for 2017. Apple, $899 billion. Alphabet, the owners of Google, $719 billion. Microsoft, $644. Amazon, $543 billion. Facebook, $518 billion. Berkshire Hathaway, $452 billion. What do these companies all have in common? None of them even existed in 1967. These are all brand new companies that didn't even exist. And each one of these companies had a founder that was motivated, and those founders tend to have high ownership. So, who has a high ownership in Apple? Steve Jobs. Who has a high ownership in Berkshire Hathaway? Warren Buffett. Who has a high ownership in Facebook? Zuckerberg. Who has a high ownership in Microsoft? Bill Gates, Steve Ballmer. Who has a high ownership in Amazon? Jeff Bezos. So, and I can't remember off the top of my head the owners, the founders of Alphabet. So this is not really all that surprising then that we're going to see a lot of wealth concentration because these are brand new companies. Unless you think this is going to go on forever, just look back to 1967. Sears has already gone out of business. Standard Oil's gone. General Motors is not worth hardly any of that. Eastman Kodak, gone. AT&T, a shell of its former self. GE is on the ropes. So things change. And also, back in 1967, if you were to look back here, you would have a lot of diverse ownership because all of these companies, as big as they were in the day, the people running them at the time were not the owners. They had very diffused ownership. They didn't have a whole lot of ownership concentration. That's because they're older firms. So even in 1967, the average firm age was pretty old compared to the average firm age here in 2017. In fact, Apple had its IPO, 1980? Microsoft had its IPO, 1986. Alphabet, 2002? Amazon had its IPO, was it late 1990s or early 2000s? I know that Jeff Bezos started out of his garage in 1994. Facebook, again, it's had its IPO just in the last 5-10 years. Berkshire Hathaway, it started somewhere in the 1970s, I believe. So these are all new companies. Innovation. To give you an idea about how dramatically things can change from decade to decade, if we look at the U.S., the top 5 tech firms in the U.S., Facebook, Microsoft, Alphabet, Amazon, and Apple, these 5 companies have the same market capitalization as the bottom 282 firms in the S&P 500. The S&P 500 is all big firms. So, new firms, high founder ownership. So yeah, we're going to see a lot of the profits going back towards the owners because ownership is concentrated. Now, another 20 or 30 years from now, who knows if these companies will be even in business, or at least they'll be recognizable today. So, and as an example of a firm with high founder ownership, Jeff Bezos, he's the founder. Again, I said he started in his garage back in Seattle in 1994. He owns 17% of Amazon, so he founded the company, he owns 17% of Amazon. That translates to a net worth, and this is last year, so it's even higher than this now. His personal net worth is $93 billion. Absolutely an outlier. All right, so we've seen these stocks over the last 10 years, 20 years, do extremely well. So the stock market, on average, yielded high returns, even to the average investor. So I'm not ever going to be able to do as well as Jeff Bezos, but I can invest in the stock market and get high average returns. So the average long-term return on the stock market after taking into account inflation is somewhere between in the years and the time frame you look at. But if you look at any 15, 20-year span of time, most often you're going to be looking at a number between 6 and 9%. That's pretty high. And yet, we can see that the percentage of people that are invested in the stock market has actually fallen. So what's going on here? Back in the early 90s and 2000, we had about over 60% of the people invested in the market, up to 65% in 2007. And then we had the financial crisis, and a lot of people got scared and just got out of the market, have not came back into the market. So now we only have about half of U.S. adults invested in the stock market. Well, the rich are going to continue to get richer if only half the people aren't investing in the greatest wealth machine this planet's ever seen, and that's the U.S. stock market. So no, this is not that the rich is getting richer, is less to do about shareholder wealth maximization rule than individual investors, individual Americans not taking advantage of the stock market. In fact, in a recent survey looking at millennials, Gen Xers, baby boomers, and the silent, we can see what's your favorite long-term investment. Well, long-term should be what? In stocks, right? Well, 38% of baby boomers would agree. Silent generation, 44%. Other people may say, real estate's better than the stock market, whatever. Gen Xers, 33%. But millennials, our youngest investors, 30% of them think cash. Cash earns almost nothing. Why would we invest long-term in cash? That makes no sense. As the old saying goes, you can lead a horse to water, but you can't make him drink. So look, again, this is kind of just numerically showing what we showed before. In 2007, about 67% of adults were invested in the stock market. 2010, it dropped down to 56. 2015, it dropped down to 55%. Now, if you look at the people that are earning high income, defined as 75,000 and over, we've got around, it hasn't really changed that much, right around 90% of people making $75,000 or over are invested in the stock market. When we look down to the people that really need to be invested in the stock market for the long haul, even if they're only spending $50 a month in the stock market, investing in some type of mutual fund, 401k, or IRA plan, which they really need to be doing. These are the people, especially young people, low income, we see that it's even falling from 72% for the middle income earners down to 56% today. And it's even worse for the less than 30,000. Again, it's less the amount that you invest every month and more that you are investing every month. And when we look at it by age group, we see, again, young people are not investing in the stock market at the same rates that they were before. And neither are people 35 to 54 or 55 and older. So we're seeing overall less participation in the stock market, and this lower levels of participation is more tied to young people. Another contributing factor is that in today's economy, most people are not going to go to work for the same company their entire life. They're going to job hop a little bit. But what happens is people have a tendency when they leave one job to another job to cash out their retirement savings. So this chart right here shows the rate at which various types of 401k, which is an employer-sponsored retirement plan, when they cash out of their retirement accounts when leaving a job. When you leave a job, that 401k, that your retirement money is yours. You can roll that over to your new job, you can put it into another long-term investment vehicle, or you can cash it out. And as we can see that young people, they're cashing out over 40% when they change jobs. So if people are changing jobs all the time and they're cashing out each time they change a job, they're never accumulating any wealth. The rich are going to get richer, the poor are going to get poorer, that gap is going to widen, but it really has nothing to do with the shareholder wealth maximization rule. Well, it has something to do with it. The biggest driver is investment behavior. Lower income people are terrible about this. These long-term retirement plans are designed to get you wealthy over the long period. Are the rich getting richer? Sure, you bet. There's no arguing that. A lot of the rich getting richer is simply that new and innovative firms, they have high founder ownership. We had a few examples here of a few big companies, but if you think even small companies, when they're starting up, the owner is the guy that's managing it and running it. So these companies, these startups are going to have high founder ownership, so we're going to see more of the wealth go to shareholders, but just because a lot of the shareholders are the founders. We also have this problem of the stock market participation rate has fallen. So is Senator Warren's proposal going to hurt or help this? Well, if we're not going to look at shareholder wealth maximization, companies are not going to make as good decisions because no longer is it going to be, say for example, investment. Will this investment returns, accounting for its risk, give us a higher rate than what financing costs? Well, if all of a sudden we have to worry about communities, workers, wages, all of a sudden we may be accepting projects that we shouldn't. Or we may be rejecting projects that we don't because we don't have a clear rule on when we should invest and when we should not. So is it going to hurt or help? I think it's going to hurt. We are just not going to have as good a way to evaluate good projects. Now, even if you strongly disagree with me and think that shareholder wealth maximization rule is just, it's greed, we shouldn't have something like that, we need to have something more inclusive to help out the little guy, all right. But just keep in mind, there's always unintended consequences. So back in 2000, since 2000, we've had more and more regulations on publicly traded corporations. And guess what's happened? Post-2000, right, we started having things like the Sarbanes-Oxley because we had a few bad apples, a few companies that were publicly traded companies that were not cooking their books so much as being less than transparent. So we have increased rules, increased regulations, increased regulatory cost of doing business, an environment where companies are getting sued by plaintiffs' attorneys for supposedly bad business practices for publicly traded companies. A lot of companies just said, fine, we'll just stay private. So we've seen the number of publicly traded companies fall from a height of around 7,500 in the late 1990s down to about 3,500 today. Now, there's still companies out there. They're just not publicly traded. These are privately held companies. And today we have this situation where the total market cap of all publicly traded companies is about 30 million trillion. And the total market cap of all privately held companies, if we were to value them, most estimates put that number somewhere around 40 trillion. So in other words, privately traded companies are more valuable than publicly traded companies as a consequence of government rules and regulations. So, just a couple of closing thoughts. Embracing shareholder wealth maximization in free markets probably won't result in gains being shared equally with the workers, but gains are going to be more likely. Workers are going to be better off, and shareholders are going to be better off because there's going to be more gains, even if they're not equally distributed. So how are the workers supposed to participate in this? Two ways. One, via higher education. The evidence is clear. Higher educated workers, more skilled workers, are getting a bigger chunk of that productivity gain, and low skilled workers are not getting any. So higher education is one thing. Second, to participate in the shareholder wealth maximization phenomenon, you have to invest in the stock market. You have to invest in companies, whether they're publicly traded or privately held. You need to invest in equities for the long haul. Closing thought, even if you completely think everything that I said is bogus, you completely disagree with me and think that we should go to some type of stakeholder maximization and move away from shareholder maximization only because the wage gains haven't kept up with the productivity gains, I would argue that even if the wage gains in dollars haven't kept up, the standard of living that we enjoy today is much higher than it was 40 years ago. So think about a lot of things you use. Your smartphone, your laptop, your desktop computer, tablets, navigation, social media, inexpensive clothing, inexpensive goods. This is all a result of continuous shareholder wealth maximization rule. So much better off today. There's so many goods that exist today that did not exist 40 years ago. And even goods that existed 40 years ago are much better and cheaper today. So for example, one of the antenna shows is it's called the Game Show Network, and they have game shows from the 1960s and 1970s and 1980s. And you can look at Let's Make a Deal or The Price is Right, any of those kind of shows from right around 1980. You might from time to time see a television set, or you might see a microwave oven or a stereo. You might think, wow, a microwave back in 1980 cost $500. And that was a basic model. I can get a new microwave today that's every bit as capable as that one back in 1980 for $100. That's not even counting inflation. And that occurs, we've had increased product quality across the board. So just look at the car market. Would you rather have a brand new car in 1980, let's say the Ford Pinto? By the way, the Ford Pinto was completely unreliable. You couldn't hardly go 4 or 5, 10,000 miles before something would break down. And they had this really bad tendency of blowing out. But if you were today to go on the used car market and buy a 10-year-old car, so buying a 2008 car today, that's used. That 10-year-old car, it could have 100,000 miles on it, and I'm telling you, it's a 10 times better car than a brand new car was in 1980. So even if wage growth hasn't kept up, our standard of living is phenomenally higher because of our free market system that we have and companies looking out for their own best interests via the shareholder wealth maximization rule. And this really isn't new. Adam Smith, way back in the 1700s in The Wealth of Nations, he noted this phenomenon. Individuals and companies looking out for their own best interests benefits society. So I say no to abolishing the shareholder wealth maximization. Hope I haven't bored you too much. I know this has been a long talk.